So they're going to come, Jim, and give a range of what they think the neutral rate is. And I don't know, maybe they change that range somewhere between 2 and 3.5%. But you point out, and the Taylor rule is, I don't know, is that a perfect world? It would be difficult to actually enforce the Taylor rule from that Stanford professor who's been on a lot. The Taylor rule would put the Fed funds rate right now at 10.5%. There's no way we're headed to 10.5%. But even if we went to half of that, that could present a risk to growth.
Oh, sure, yeah, yeah. I think the Taylor rule is it means to compare desired inflation with the existing inflation. It means to compare desired GDP growth with what we have. It's a rule of thumb. But not so long ago, Ben Bernanke termed Professor Taylor's influence on monetary policy as profound. And I think what is notable is the gulf between the 25 basis point Fed funds rate we have and the 10.5% funds rate that Professor Taylor would impose. There are other signs as well of the sheer redundancy of dollar bills in the system. The Fed runs something called the reverse repo facility, which is a $2 trillion or thereabout repository of dollar bills that the banks have no place to put except at the Fed to earn, I think, 30 basis points a year before tax. So the gulf between the funds rate and the Taylor rule on the one hand and the sheer size of this reserve, reverse repo thing give you a sense of just how extraordinarily loose the Fed has been and for how long it's been. I mean, this is a unique episode in monetary affairs. It's truly, it is something for the ages.
Right. Well, it's worrisome for a number of reasons, not the least of which is that I don't know what it says about asset values, when now we know in hindsight how much money was sloshing around. So I don't know how much air is still under a lot of it, different assets, take your pick. But you also think it will cause the Fed to raise rates quickly to try to head off a bout of stagflation, which is the worst. If they do it fast, if they do it quickly, will they not have to go as high or is that what they're hoping? They won't have to go as high if they don't do quarter point increases?
Well, on Wall Street, there's this phrase, she missed his or her market, missed your market. And I think there's a chance the Fed has missed its market and that inflation, like some kind of virus, is in fact now rooted in the body finance. I don't know. I mean, there's also the risk that I think it's a very strong risk that the Fed, in its belated hurry to lift interest rates, is going to force a financial accident that was perhaps inevitable owing to the buildup of debt over so many years, owing to all the misdirection of capital that is attendant upon a manipulated and suppressed rate of interest. The backstory to all this is that interest rates are the traffic signals of a market economy, the most important and consequential prices in capitalism. And they have been an instrument and remain an instrument of public policy. They're not discovered in the marketplace. And it is this distortion, the distortion of the basic price we use in discounting cash flows and setting investment hurdle rates and measuring credit risk. It's this distortion that is now in play, now to the forefront. And, in a way, the Fed, in trying to protect its image and its reputation, reminds you a little bit of Xi Jinping, who's painted himself in the corner with zero COVID.
Yeah.
Once a bureaucracy gets an idea into its head, it's hard to reverse it.